Hey there, fellow investors. Welcome to a fascinating journey into the world of finance. Ever wonder how some people make money when the market tanks? It might seem counterintuitive, but it's a strategy that savvy investors have been using for years. It's not magic, it's short selling. This technique allows you to profit from falling stock prices, turning market downturns into opportunities. Think of it as the ultimate contrarian play, a way to profit when others are panicking. Sounds intriguing, right? Imagine being able to make money while everyone else is scrambling to sell. Let's dive into the world of short selling and see how it works. We'll explore the ins and outs of this powerful strategy. Short selling might seem complicated at first, but don't worry, we'll break it down together. We'll start with the basics and gradually move to more advanced concepts. It's all about understanding the mechanics and managing the risks. Risk management is crucial in short selling, as the potential losses can be significant if the market moves against you. So buckle up and get ready to learn about a powerful tool that can help you navigate even the most turbulent markets. By the end of this video, you'll have a solid grasp of short selling and how to use it to your advantage. To start, let's understand the basic concept. In short selling, you borrow shares of a stock from a broker and sell them at the current market price. The goal is to buy back those shares later at a lower price, return them to the broker, and pocket the difference as profit. However, it's important to note that short selling comes with its own set of risks. If the stock price goes up instead of down, you could face significant losses. That's why it's essential to have a solid risk management plan in place. This includes setting stop-loss orders and being prepared to cut your losses if the market moves against you. Additionally, short selling requires a margin account, which means you need to have sufficient funds in your account to cover potential losses. Understanding the costs associated with short selling, such as interest on borrowed shares and margin requirements, is also crucial. By being well-informed and prepared, you can use short selling as a powerful tool to enhance your investment strategy. So, are you ready to take the plunge and explore the world of short selling? Let's get started and turn market downturns into opportunities for profit. Okay, let's cut to the chase. In the world of investing, there are countless strategies to make money. But today, we're diving into one of the most intriguing and often misunderstood tactics: short selling. Short selling is essentially betting against a stock. It's a strategy used by traders who believe that a stock's price is going to decline. You're borrowing shares you don't own, selling them at the current market price, and hoping the price goes down. This might sound straightforward, but it requires a keen understanding of market trends and timing. If it does, you buy them back at the lower price, return them to the lender, and pocket the difference. Sounds simple enough, right? But remember, if the price goes up instead, you could face significant losses. Well, like anything in the stock market, there's more to it than meets the eye. Short selling involves risks and complexities that can be daunting for the uninitiated. It's not just about predicting a price drop. It's about understanding market sentiment, financial health of companies, and broader economic indicators. But stick with me, and you'll be fluent in short selling lingo in no time. We'll explore the mechanics, the risks, and the strategies to mitigate those risks. We'll also look at real-world examples and case studies to illustrate how short selling works in practice. Remember, knowledge is power, especially when it comes to your financial well-being. By understanding short selling, you can make more informed decisions and potentially add a powerful tool to your investment arsenal. So let's get started on this journey into the world of short selling. Think of it like this. You borrow your friend's fancy car, the stock. Imagine it's a sleek, shiny sports car that turns heads wherever it goes. Your friend trusts you enough to lend it to you for a while. You then decide to sell this car at its current market value. Let's say the car is worth $100,000 right now. You find a buyer who is willing to pay that amount and you make the sale. Now you wait. You hope that something happens to decrease the car's value. Maybe it gets a dent, or perhaps a newer model comes out, making this one less desirable. The car's value drops to $80,000. You then buy back the same car at this lower price of $80,000. You return the car to your friend, who is none the wiser about the transaction. The difference between the selling price and the buying price, $20,000, is your profit. That's short selling in a nutshell. It's a strategy used by investors who believe that the price of a stock is going to decline. Of course, in the real world, you're not dealing with cars, but stocks. Stocks represent ownership in a company, and their prices can fluctuate based on a variety of factors, including company performance, market conditions, and investor sentiment. And instead of borrowing from a friend, you're borrowing from a brokerage firm. This firm lends you the stocks, expecting you to return them at a later date, but the principle is the same: profit from a price decline. Investors use this strategy to capitalize on anticipated drops in stock prices, aiming to buy back the stocks at a lower price and pocket the difference. However, it's important to note that short selling carries significant risks. If the stock price goes up instead of down, you could face substantial losses. Therefore, it's a strategy best used by experienced investors who understand the market dynamics and are prepared for the potential risks involved. Let's say you notice your neighbor's lemonade stand isn't doing so well. The lemonade is too sugary, and people are opting for the ice cream truck instead. You could say that you're short on your neighbor's lemonade stand because you believe their business will decline. This analogy might seem silly, but it highlights the core concept of short selling: identifying an asset like a stock or a lemonade stand that you believe is overvalued and poised for a decline. The housing bubble: a short seller's dream and a cautionary tale. Remember the 2008 housing crisis? Some savvy investors saw it coming and made a fortune short-selling mortgage-backed securities. They recognized the housing market was inflated and bet on its collapse. This example shows the potential of short selling, but also its risks. Shorting is risky because your potential losses are theoretically unlimited. If the stock you short goes up instead of down, you'll have to buy it back at a higher price, losing money. Risk and reward: the high-stakes game of short selling. Short selling can be lucrative, but it's not for the faint of heart. It's a high-risk, high-reward strategy that requires nerves of steel and a deep understanding of the market. Remember, you're going against the grain, betting against the collective wisdom or sometimes the hype of the market. Before you even think about shorting a stock, you need to do your homework. Thorough research, careful planning, and a solid risk management strategy are crucial for any short seller. Short squeezes: when the market bites back, short selling isn't without its pitfalls. One of the biggest risks is a short squeeze. This happens when a heavily shorted stock starts to rise, forcing short sellers to buy back shares to cover their positions, pushing the price even higher. Imagine a stampede of panicked investors all trying to exit a crowded theater at the same time. That's what a short squeeze can feel like, and it can lead to massive losses for those caught on the wrong side of the trade. Not just for hedge funds, shorting ETFs and inverse funds. Short selling isn't just for Wall Street hotshots. Individual investors can get in on the action too, though it's generally considered riskier for them. One way to short the market without the complexities of traditional short selling is through ETFs and inverse funds. These funds are designed to move in the opposite direction of the market or a specific index. They offer a more accessible way to profit from market downturns without the unlimited risk of traditional short selling. Knowledge is power fighting financial illiteracy together. Understanding complex financial instruments like short selling is a crucial step in combating financial illiteracy. The more we know about how the markets work, the better equipped we are to make informed financial decisions. We're all in this together, folks. Let's empower ourselves with knowledge and create a more financially literate world, one investment at a time. Join the movement. Your financial literacy journey starts now. This is just the tip of the iceberg when it comes to short selling. There's a whole world of strategies, techniques, and nuances to explore, but hopefully, this gives you a solid foundation to build upon. Remember, the best investment you can make is in yourself. So, keep learning, keep exploring, and never stop striving for financial literacy. Keep learning, keep growing resources for the savvy investor. Ready to take your financial knowledge to the next level? There are tons of resources available to help you become a more informed and confident investor. Check out reputable financial websites, read books by experienced investors, and consider taking online courses. The journey to financial literacy is ongoing. Stay curious, stay informed, and remember, the more you learn, the better equipped you'll be to navigate the exciting world of investing. Don't forget to check the link in the description below. Give this video a like, share it with your friends, leave a comment, and subscribe to our channel for more valuable information.